good to go, Don. We're going to spend some time here talking today. It's right at the end of June. 4th of July is coming up this Saturday, and here we are, halfway through the year, into the second quarter today. It's been quite a year, and it's been quite a quarter. Really something. You got any thoughts about the markets? I know you and I don't make directional calls. We don't invest that way, but we do make environmental assessments. I call them.
Well, it's we get asked about the markets, from friends and family and different people and calls, and just with the little bit of a change of direction with the virus issues, I've had a few more conversations about that as a factor in the overall market direction. And my explanation is simply, we went down very fast, a meltdown, and we melted back up again. And now we are somewhat in a neutral area. Neutral to me is that there is a big battle going on between the bulls and the bears, and we're in a neutral state. And I would expect before we have our next monthly update, we might have a better hint as to direction. Now, it may go further and further out, but it would take some significant news both ways to either drive it down or to send it forward. And I think the thing that will propel the market eventually will be some upgrading of information about a solution to the virus.
Right.
And yet, I think always we prepare for the worst. It's in the building of the models and in how we look at things, because it's the heart and soul of never having to come back a long ways to get back to where we can get back to making some of that new money. New money is better than old money. So.
That's right. Yeah.
Well, you asking me the hard question, and I didn't give you a good answer. Give me a little bit of an update about our portfolios, about maybe like month to date, because I think daily and weekly is a lot of noise involved. Over the last month, maybe we're at the first half of the year, or year to date now, I guess would be the right problem. And then maybe even taking a further picture out, maybe the last 12 months or so.
Yeah, I'm sure. I actually have that stuff here. I'm looking at all of our different, we break our things down into strategies and portfolios, and the strategies are the underlying, in stock selection, rules, and we blend those strategies together to create portfolios to fit certain risk and return, needs for us and for other investors. So I'll talk about the strategies first. The momentum, that's our most volatile strategy. It really is. It's really a remarkable strategy. Year to date, that thing's up about 37%. Last 12 months, about 52%. It's currently in a very, very small drawdown after yesterday, for actually the last 4 days. So it made a new high 4 days ago. Quarter to date, it had a 56% quarter, just owning 3 different stocks. That was pretty remarkable. Our low vol strategy year to date is down 8%. For the last 12 months, it's down 0.5%. Currently in a drawdown of 17%. But we haven't had much chance to make good on that, to make up, because our low volatility filters kept us from owning anything since the end of February. March, April, May, June, we've been actually just sitting in cash in that strategy. So it hasn't made anything. It hasn't recovered. I'll talk a little bit more about that in a minute. Yeah, because
I,
it's
we spent a lot of time what you're going to talk about. You and I have
uh,
to do that, but I think it's an interesting point, and it also qualifies the fact that we're not just sitting around. We're always
oh
doing
yeah,
things to
we're
try to
all,
upgrade and learn and take good ideas from other places and use them to.
yeah. And now don't forget now, when we go to the portfolios, it's blends. So, if you have one strategy and 40% of your portfolio or so is up 56% for the quarter.
Pretty good.
Yeah, you can put up with a little bit of drag from, just sitting in cash too. So, our aggressive portfolio um, is for the quarter up about 18%, year to date about 14%. Um, so real happy with that. Our defensive growth, which is our moderate stuff, where you and I have nearly all of our own investment monies, um, month to date up about 5%, quarter to date up about 11, year to date it's up almost 10. And I don't have well, I do have an inception number here. Hang on. Since inception, it's got an annualized return of 14.5%. So, and that's a real portfolio. That's not even the model. That's real money. And so I'm real happy with that. The S&P during the same time period is up 7. So we're up twice in that portfolio what the S&P is over the last year and a half or so. Our target for this is 10 or 11% annualized return. We're above that, so I'm not unhappy. And our maximum drawdown in the portfolio was 12%. The S&P had a 34% drawdown, so we got twice the return with just a third of the risk. So, from my perspective, these things are working exactly like we designed them. Now, that's not to say that there aren't things that I think that can be improved on these things, and you always want to be careful when you tweak things. But there were two things that we've been taking a look at over the past few months. The software that we use to generate our trades and to generate our tests and everything, OmniBroker, an incredible piece of software, but it has its own little quirks. Um, one of the one of the quirks that it has is it's very difficult without some really fancy programming to know when the end of a month is here until you've already reached the end of the month. So in other words, OmniBroker can't know. OmniBroker determines it's the end of a month by looking at the next day, and it says, so let's say today's the 30th. It's Tuesday. On Wednesday, we would run OmniBroker, and it would say, "Hey, is today July 1st? Is that a different month than yesterday?" Well, the thing is, you already have to have yesterday's data in order to know whether whether yesterday was a trading day or not. By the time you get that data, the day's over. You can't trade. So we've always traded on the first of the month, but our models have always modeled trading on the last day of the month. That made a big difference for us back in February with Tesla. For about a year, I would say the model and the portfolio were tracking within a few basis points of each other every day. It was just exactly what we wanted to see. Then Tesla came on as a buy for us. Well, our models calculated that they bought it at the end of the day, at the end of February, the last day of February. Well, we actually went out and bought it the next morning, but it had jumped 20% overnight. so we, the model thought it got it at a very low price. And, our actual portfolio, the live account, got it at a, 20% higher price. So we did not get all that gain in there that the model got, and that separated the two. And so
And you got a better price than I did. I
That's
was
right.
able
Yeah, I traded a little earlier than you did, and I got a little bit better price, but still, it made a big difference between the model and the actual account, and um, that set us to trying to find a way to get the trading data so that we can actually trade at the same time, this on the same date, and as close to the same price um, as the model does, which is the end of the month rather than the beginning of the next month. So normally those things offset one another. If you buy the next morning, or early the next day, sometimes it hurts you, sometimes it helps you, and it pretty much evens out. But they stay very close, and for almost a year, that's what we were doing, and they were within a few pennies of each other. But when you get a thing like Tesla and these volatile markets, it made a difference between the model and our portfolio. The model was better. Well, that could go another way too, but we don't want to wait around to get a signal to buy something and then wait the next morning and wait for the price to drop 20% so we get it at a better price. What we want to do is trade as close to the models as we can. So we have tricked tricked our software into knowing when it's an end of the month without having to have the end of the month data in hand yet. And we're going to be rolling that out probably the end of July. There'll be some instructions ahead of time, but it's going to make actually trading a lot easier rather than getting your trading allocations and having to do something as close as soon as possible after you get those. You'll get your trading allocations, and then your goal will be to trade as close to the end of the day as you can, and you'll end up getting as close to the model price as possible. That's one. That was kind of a long explanation, but we think that that's going to help us stay closer to the models, be more accurate, and get more what we expect. The other thing is, even though I'm really happy with what we're getting now, I'd like to be closer to the model. The other thing that we're doing is we knew this to be the case, based on our testing and everything, that our low volatility strategy really protects very, very well against market meltdowns. What it does not do is jump back in and let you get back into the market, at the most opportune time. It's so careful that you set up waiting for signals to come and permission to own stocks that are not so volatile. Even so, we look at that V that we had this second quarter, that melts up, as you called it. Well, that we still technically measure that as volatility, and we still aren't permitted to own those stocks or any stocks because it's volatile. So we've done a couple of things, and our goal was to make sure that we did not disturb the underlying logic of the system. But what we did was we fine-tuned our measurements of market conditions so that we actually have, instead of one final determinant of what's permissible, in terms of volatility, guiding number that moves up and down depending on market conditions. So it allows us to re-enter the market when it's safe, because it lowers our maximum allowable volatility when the market's weak, raises it when the market is not. So that actually, you won't see anything like that. You'll just see that there's instructions to own. You'll probably find that if we have more meltdowns, you're sitting in cash less time. You'll be able to take advantage of rising markets again more quickly. So that's for our low vol. Again, I'll go back to the numbers that we're talking about, where real time annualized return over the last year and a half, 14% with the market at 7%. 12% max drawdown on a moderate portfolio, defensive growth portfolio, versus 34 for the market. Boy, Don. I mean, if you could have told me that here we'd be sitting, halfway through the year, with those kinds of numbers. Could guarantee me that and say that's what we're going to do. There's no guarantees, of course, but this thing has done exactly what we hoped. Just exactly what we hoped. It worked. I'm so pleased.
It was built for safety first purposes. That means we don't want to have to deal with digging out of big holes, and I couldn't. It has been almost exactly what we perceived it to be.
Mm-hmm.
And anytime you develop something, until you get with live bullets, you always say, well, maybe it might be a little different. This has been probably the most consistent thing I've seen in 30 plus years in terms of doing what we're attempting to do, which is to provide a good, steady return stream with as least amount of volatility forward.
Yep. Yeah. On over the weekend, I sent out a weekend update and talked about, us having had some of our, pride knocked out of us over the years, just by going through this stuff, and we're more humble now than we used to be, but and part of that humility is saying, look, let's not say that this, there will never be a situation that we didn't see coming, but I'll tell you, there's an incredible amount of confidence that comes living through the first half of 2020 with these markets and these portfolios trading live, and seeing them do exactly what you designed them to do. That feels good.
Yeah. Taking our portfolios back to the markets, I think we have to be prepared to participate if the market goes up, but we also need to consider we're not but just a couple of jumps away from having some negative market conditions.
Mm-hmm.
And people who have been through the down and the up may not want to go through another down, and you might see a little selling into it, which could bring the market into a little faster. Down is faster than up, and but the truth is, I think we have the tools to deal with it. And
yeah, we are in what you and I call the indecision envelope, and whenever we trade at the end of a month and we're trading and the market is in that envelope, we have a couple of rules in place that allow us to modify our allocations during the first half of the month if we need to. It doesn't happen very often. In fact, I think once in the last couple of years that happened. But we are at an inflection point. Don't know where it's going. It's we've had some 2 and 3% down days in the last 2 weeks, that's pretty volatile. So, am I right? Or is that normal now? I don't know. I long for the good old days when you were up 30 basis points on a day, but anyway, so
I think to sum up, I think we're pleased with our approach so far. We diligently work at it to try to anticipate everything that might come up, which is impossible, but we're never satisfied. This is an ongoing thing, and we spend an inordinate amount of time to do our best.
Yes, we do. Yep. All right, my friend. Hot and humid up here today, and last night we started working on a stone wall down by our pool area. It was a project we started about 20 years ago, and as I've gotten older, it's getting harder to do by myself. But with my son working at home for the rest of the year, his firm has him, working remotely, so he doesn't have an hour commute back and forth. So he said, let's take that hour commute that I used to do every day, and let's try to take that down, and we'll try to finish that stone wall. So yesterday we mixed up a couple of bags of mud and start laying stone. So we'll see. Took us about 2 hours to do 2 bags, and I calculate we're going to need 40 bags to do the wall. So 20 more days. Yeah.
I was going to come up and visit you, but I think I'm going to put it off for a little.
Come on. Make sure you bring your work gloves. Anyway, all righty. Well, you take care, and I'll talk to you real soon.
Yes, sir.
All right.